Financial institutions across East Africa are perceived to have lost $30 million in the last 1 year to financial crime. This is according to findings contained in the Deloitte Financial Crime Survey of 2013, which asked banks, insurance firms, real estate companies and the capital markets across East Africa to state what they felt they lost to fraud and other crimes. For more, I'm joined by Robert Nyamu. He's the Director of Forensic Services at Deloitte East Africa. Robert, thank you so much for making the time to join us. Let's start off with the perpetrators. Who's committing the crime?
According to the survey, the crimes are actually being committed across the board by non-management staff, management staff, as well as senior management staff. So it's a wide cross-section.
And why? And go ahead, Robert.
Sorry, I was going to say that it actually involves, in most cases, a combination of internal and external parties, so through collusion predominantly.
Let's look at the triggers behind these crime statistics. What causes such prevalence of financial crime?
The main issue, the prevalence of financial crimes, especially within the financial services industry, is the abandoned liquidity within the industry, and also the innovation of fraudsters in terms of the way they're actually executing these crimes, being mismatched with the manner in which some of the financial services players are actually trying to deal with this crime. So we're finding a situation where fraudsters are in some cases staying a step ahead of the institutions themselves.
I mean, if we look at the report, one of the striking things for me was that quite a significant amount of this crime is cash theft. What does this say about the sophistication of the financial services industry in the region?
What basically that demonstrates is that the financial services industry across East Africa is still going through some maturity. So we're not seeing a lot of the cybercrime and card thefts, contrary to what we see in South Africa, for example, or in Europe, which means that the industry in East Africa is still going through that growth phase where a lot of people still need to embrace mobile banking, internet banking, and these other forms of these other modes of delivery within the industry. So a lot of the theft is still happening through cash and checks and other traditional forms of transacting.
Robert, if you may just quantify for us, understanding that the figure is $30 million lost in the past year, how does this compare to other regions in Africa?
It's difficult to put a figure on what's happening in the other regions in Africa, but what I can tell you is within East Africa for this past year and what we saw in the previous 2 years, because in the previous 2 years what we found was that a figure of about 4-point-something billion shillings was lost and over a 2-year period, and this year we're talking about a figure of about 2.5 billion, according to the views of the industry players. So that is consistent with what we found last year, and in actual fact, it has grown somewhat. It's actually gone up a bit.
And what has been the response of the industry in terms of their detection and prevention mechanisms?
What we've seen is quite a disparity in terms of embracing prevention and detection mechanisms, where you find the banks. A lot of the banks are actually quite advanced in terms of the techniques and mechanisms they're using to prevent and detect financial crimes. But for the other industry sectors like insurance and the others, we didn't find that sort of level of sophistication. So there's quite a disparate range of techniques that are being used there, and also across the 3 East African countries there's also a deviation in terms of maturity levels across the sectors.
And very quickly before I let you go, I understand that it's possibly easier to quantify the financial losses, but how are firms dealing with the reputational losses that come with financial crimes?
I beg your pardon?
It's possibly easier to quantify financial losses in dollar terms, but how are the firms and the industry at large dealing with the reputational losses that come on the back of financial crime?
Right. Actually, in the study we did, we found that a lot of the players ranked reputational risk as the highest possible impact of financial crimes. And that is actually the predominant reason why a lot of them do not want to report financial crimes whenever they occur. And so what we're seeing is a situation where the figures that are actually reported and that you see in the media are just a fraction of what's actually happening. And this is something that we're engaging the players about. And hopefully there would be a better collaboration with, at least amongst the players, to share information on these frauds that are happening and the financial crimes that are happening, so that they're better addressed going forward. So reputational damage is by far the most profound impact for them, and they acknowledge that.